Most traders only know how to make money when stocks go up. But the biggest, fastest moves in the market happen on the way down, and almost nobody has a systematic way to profit from them. Today, I am going to show you a rules-based shorting system, backtested on SPY going back to 1994. It does not trade often, but when it does, it has a 70% win rate. Here is exactly how it works. This system is built around one key insight. When SPY is trading below its 250-day moving average, the market is in a bear regime. Price behavior changes completely in bear regimes. Countertrend bounces are weak, and they fail. This system is designed to short those weak bounces. It waits for price to pop back up toward the 5-period moving average. It waits for the 3-period RSI to push above 70, which signals the bounce is getting overbought, and it requires price to still be at least 2% below the 250-day average, so you know you are still well inside bear territory. All 4 conditions together tell you the same thing. The primary trend is down. There has been a short-term pop, and the environment still favors the short side. Here are the 4 conditions that must all be true on the same day to trigger a short entry. Rule 1. SPY must close below its 250-period moving average. That confirms the bear regime. Rule 2. The closing price must be greater than the 5-period moving average. That is the short-term pop you are looking for. Rule 3. The 3-period RSI must cross above 70. That is the overbought signal on the bounce. Rule 4. The close must be at least 2% below the 250-period moving average. This keeps you away from the moving average itself, where direction is still ambiguous. You need all 4. If any one condition is missing, you do not take the trade. The entry is executed the next day at the open. Exits are just as mechanical as entries. There is no discretion here. Exit 1. SPY closes back below the 5-period moving average. The short-term bounce has failed. That is what you were waiting for. Exit 2. SPY closes above the 250-period moving average. The bear regime may be ending. You get out immediately. Whichever happens first, you exit the next day at the open. These are not stop losses in the traditional sense. They are regime exit signals. You are not bailing because of pain. You are exiting because the reason for the trade no longer exists. Now let's look at what 30+ years of backtesting actually shows. The win rate is 70.16%. That is high for a short system. Most shorting systems struggle to get above 55%. The average winning trade gains 1.77% and is held for just over 3 bars. Fast, clean exits. The average losing trade loses 2.12% and is held for about 5 bars. So losers hold a bit longer and cost a bit more than the winners gain. That is the trade-off. But the win rate more than compensates for it. What you are really seeing here is a system that concentrates its activity in genuine bear markets. 2001, 2002, 2008, 2009, 2022. In most years it does nothing, which is also the correct behavior. Staying out when the conditions are wrong is part of the edge. One more thing worth mentioning. The signals are generated on SPY, but you do not have to execute only on SPY. During bear markets, correlation across large-cap names tends to spike. Most stocks move down together, so a SPY signal can serve as a trigger to short other names you have been watching. Individual stocks, sector ETFs, whatever fits your situation. The 250-day MA condition on SPY is the key piece. Use it as your regime filter to decide when the environment is right. Then you have options in how you express the trade. That is the complete system. 4 entry conditions, 2 exit conditions, all entries and exits at the next open. No optimization, no curve fitting. These are the raw results back to 1994. If this kind of rules-based, systematic approach to trading interests you, subscribe. I will be walking through more systems like this, long and short, built for specific market regimes. The goal is always the same: objective rules, historical results, no hype. Thanks for watching.